everybody. My name's Andrew. I'm from Nonsen. Thanks for sticking with us through the technical difficulties. Going to be talking to you guys today a little bit about citizen journalism and the sudden rise in the sophistication of on-chain analytics that I've seen in the past 2 years, both from the traditional media and their willingness to use on-chain data in their reporting, but also with retail traders. And you know, the sudden awareness that in order to survive and thrive in these markets, you really do need to be using analytical tools. This was best seen during the collapse of FTX and Alameda and the rise of a very unique citizen journalism movement on Twitter and elsewhere. One place that best exemplifies the shift that I've seen over time, really in the past 2 years, with people getting a lot better with on-chain analytics, I think you can tell that story through one Ethereum address in particular. This is 0x0FA. I think veterans of the on-chain trenches will recognize this address just by sight. This was at one point a very famous Alameda wallet. While it was never their largest wallet, Alameda routinely had multiple wallets with $1 billion or more in assets. This was one of their most active and their most successful. This had thousands and thousands, hundreds of thousands of transactions over the course of its life. By our research at Nonsen, we found that this is the single most profitable address on the Ethereum blockchain as measured by profit and loss in decentralized exchange trades. This address was highly involved in a lot of arbitrage trades. They were involved in a lot of liquidity provision, the early days of SushiSwap in particular. But in addition to these kind of programmatic and sort of market makery kind of stuff, they were probably doing some MEV stuff on this address as well. They were also engaged in a lot of swing trading. So traders like me in 2021, 2020, you could copy trade this wallet with a high degree of success. They did a lot of trades with sort of mid-cap in terms of market cap tokens with high volatility. They made a ton of money on Chainlink. They made a ton of money on SushiSwap. Early in its life, they had a non-negligible percentage of the total circulating sushi supply, and a lot of stuff with Lido as well. I had a chance, though, to talk with Alameda Research CEO Sam Trabuco about this exact wallet, however, and it gave me a lot of insight into, I think, how funds were thinking about analytics even just 2 years ago. I was working as a journalist at the time. I was down in Miami for Bitcoin Miami, interviewing SBF. I love this photograph. The universe was trying to tell us, even back then. There he is standing in front of Darth Vader and stormtroopers. We weren't listening. We didn't get it. But after our interview, he introduced me to Sam Trabuco. I told him that I was thinking about starting a blog or a newsletter or something where I'd track certain large funds and their wallets on chain. At the time, on-chain analytics was still this kind of niche industry. It was still considered very crunchy. It was only something that nerds did. And after I told Sam this and discussed a few wallets I might track with him, he gave me one of those classic Sam Trabuco smiles. You know, the bad ones, the predator ones. It's a smile you can feel in your spine. It's not a good smile. And he said, I can see why you would think that would be useful. I love that line. It revealed to me that there was this kind of blasé arrogance and indifference that major funds like Alameda had when they were thinking about on-chain analysis. You know, this was June 2021, just a few months beforehand. Alameda very famously took $80 million in a new project's token, Reef, and after signing an angel investment agreement with them, took those tokens, sent them directly to Binance, and dumped them very, very hard. And this was the kind of stuff they were doing in tagged and known wallets, but they felt confident enough doing it because there wasn't this broad, wide community of people who were watching these kinds of transactions and calling out that sort of bad behavior. They simply didn't care. Even just 2 years ago, a year and a half, funds were aware of the fact that people were tracking their wallets, but there just wasn't enough. There was enough complexity that they essentially had anonymity by virtue of that complexity. Nobody was willing to look at these things and call them out in mass. You know, Zach XBT didn't really exist yet, that sort of thing. And in particular, certain things like emptying out wallets once they had been identified. Sam told me they would just simply never bother with that. It was too expensive. Nobody cared. Nobody cared that this stuff was public. Nobody cared that everybody could see it. A year later, this is a profile from the Wall Street Journal. This was written by Alexander Ospovich. I love it. This is 3 months before the collapse of FTX and Alameda. We're still doing the photos with him in the light instead of the photos with him in the shadows. You can tell, you can sort of track the whole fiasco through those. But Alexander Ospovich reached out to our firm, Nonsen, to gather some data on this. This was the first time really I had seen this. One of the really, really big and well-respected financial outlets was really getting serious about on-chain data. So I told them about 0x0f. I said, this is the single most profitable address on Ethereum. I think it's really interesting, and it's an insight into how complex these guys are, how wildly successful they are, and if you really dig deep here, I bet you're going to find some interesting stuff. 4 days later, that address was shut down. In a series of 200 transactions across 3 blockchains, the single most profitable address ever on Ethereum, they emptied it out. Now, this could be a coincidence. I don't think so. My thought is that the idea of the Wall Street Journal looking into somebody's, a major fund's blockchain address really put the fear of God in them, and they cleared out. That is a major shift from, again, that sort of ambivalence and arrogance that the fund displayed even just a year before. And I think there's going to be a whole lot more of that. I think, you look last week, Forbes, despite the fact that Binance bought a huge stake in Forbes cut them in half with this wonderful report on how Binance Smart Chain synthetic B tokens were not adequately backed throughout the entirety of its life. This was sophisticated on-chain analytical work from a major mainstream financial outlet. I really can't overstate how big of a change that is. Aside from the Wall Street Journal, usually when people look to us for a quote, I have to spend an hour explaining the difference between a centralized and a decentralized exchange. I have to explain what a smart contract is. I have to explain the principles of custody versus, non-custodial wallets. And now for these major outlets, this B token report, it was really remarkable. A lot of it came from the analytics firm Elliptic, but a lot of it came from in-house research. And we're seeing this with other outlets as well. Bloomberg now has a dedicated crypto team. They poached a lot of my former colleagues at CoinDesk. They're really staffing. They're spending the money on it. Jeff John Roberts, who worked at Fortune, was fired because he was too interested in crypto, went over to work at Decrypt, and now Fortune has hired him back. And he's being allowed to build out a full staff. These outlets are realizing that you need to spend the resources and you need to get the access and you need to get the expertise in order to really cover this industry. I really cannot overstate how dramatic that shift has been in merely 18 months. Mainstream media isn't the only place where I'm seeing this increase in sophistication, however. During the collapse of FTX and Alameda, we had this we called it citizen journalism. Everybody probably knows FBI Femboy, everybody probably knows Autism Capital, who were sort of taking in all of these rumors and spitting them back out. That's not the stuff that interests me. What I saw instead were a lot of amateur blockchain sleuths of varying degrees of skill, finding and amplifying key blockchain information that other people would then pick up on and iterate on, and this consistently led the story, much faster than mainstream or even crypto-native outlets. And one example here, 2 days, this was November 6th, so 2 days before FTX halted withdrawals, Spreak, who's a great follow, was tracking how many stablecoins FTX actually had left on the exchange. We were watching things like Alameda withdraw shitcoins from farming protocols and depositing on FTX just to be able to honor withdrawals. This obviously added to the panic. It accelerated the bank run, and this kind of information was really crucial to some people getting ahead and managing to stay alive during all those blowups. There was a lot of this. I'm going to point out one of mine, though, because I'm vain as well. Similarly, a few days later, after the withdrawals had been halted, I called attention to Bahamian residents being able to process withdrawals. And now I imagine that the clawbacks from those withdrawals in that period are going to be pretty significant for the bankruptcy proceedings. Again, I think this is a significant change in how on-chain analytics used to be perceived. There was a time when it was for the nerds, it was very crunchy, it was perceived to be difficult. And now even, NFT degens, they know how to navigate Etherscan. Most people have a subscription to one or more analytical services like Nansen. And this has significant impact, I think, for the way institutions and influencers and anybody with any significant amount of money on chain is going to begin to conduct themselves. When retail, it's become a subgenre of content, hasn't it? Sleuthing. Zach XBT does great work, but there are many shades and shadows and half versions of him who get hundreds of thousands of followers doing just little investigative things on chain. And similarly, we see the same thing in the media. These large professionalized teams and a willingness to single out entities and explicitly tie blockchain addresses to individuals or institutions. There's no precedent for that. And for 5 years ago, the first time Ethereum was mentioned in the New York Times, it was misspelled. There was an I instead of the third E, Ethereum. Think about now, Bloomberg has a full crypto team, and that happened in 5 years. That is extraordinary to me. This also means, however, that the work of on-chain analysis is going to get infinitely harder. There are a few exceptions, I think. You think about Golden Tree, few weeks, I think a month at this point back, they announced a big investment in sushi, and they sort of tagged their own wallet to demonstrate that they had those holdings on chain. It was an institutional show of confidence in the asset, and it succeeded in pumping the price of that asset. So there are individuals, and I think it's going to be the same trend for NFT influencers. People are going to want to show their histories and show that they're proficient in flipping these assets. But unless you're very purposefully doxing yourself, if you want to display clout, unless you want to psyop some people, there's no reason for you to be public. And as a result, I think we're going to see more and more addresses, high-profile addresses, clear out, clean out, like the Alameda 0x0f wallet did. And it's going to be very easy for people to do this too. Centralized exchanges effectively work as mixers. It's very similar to how Tornado Cash works when you're actually looking at it on chain. You send assets to a big pool, hi Danny, and you wind up pulling those assets out of that pool later. That's what it looks like when you deposit it into a centralized exchange from an analytics perspective. And so washing and anonymizing is extraordinarily easy. And what this ultimately means is that the overall amount of funds from institutions and influencers is going to trend down, and I don't see any reason why that would stop or change. The work of analytics is going to fundamentally get harder, and it is going to be less an exercise of attempting to tie addresses to individuals and institutions, and instead work centered on trying to find the absolute highest value addresses despite not necessarily knowing who they are. I want to give you 2 examples of this. I have heavy LSD bags. I'm a big Lido bag holder, and so I'm using our platform to check on Lido a lot. Here we have fresh wallets for token. These are wallets that have been started in the last 15 days. They have no prior history on Ethereum, and they have significant inflows. So the first one I'm looking at is this fresh wallet that has inflows of $44 million and has a token balance of $34 million. As a bag holder, I want to know who that person is. That's very important to me in my position. Are they going to dump on me? But looking at the wallet, it takes 2 clicks. You can see a transfer from Dragonfly Capital, well-known VC outfit. They're transferring 14 million tokens. We know that this is Dragonfly. They're just moving it to a new address for whatever reason. This is what analytics used to look like. You click 3 buttons, and you know with a reasonable degree of certainty who somebody is and what they're doing with their funds and why. That's going to get much, much harder. Let's look at that second address, that 6.4 million inflow. I want to know everything about this guy. This address was started February 24th. He's got $130 million on chain. Massive address, massive wallet, centimillionaire, and he's holding multiple assets that I care about. In addition to Lido, he has Frac shares, another LSD play. He has $81 million in USDC. I want to know if this guy is going to dump his Lido and his Frac shares, because those are not high liquidity assets, and if you dump in an inefficient or very fast manner, I'm going to be seeing a lot of red candles and I'll be upset with you. But I also want to know if you're buying things. If you have $81 million in dry powder, I really want to know this person. I want to take them out to dinner. I want to learn their hopes and dreams. I want to be in this person's head. This is an important wallet to me and my holdings. I'm also just interested. Who spins up a wallet a week ago and then puts 130 million in assets on it? That's insane to me. We look at their counterparties. There's not a lot of clues. With the last wallet, that $44 million inflow, 2 clicks, we could see a connection to Dragonfly. We knew it was Dragonfly. Here, the only counterparties we see are primarily centralized exchanges. Whether consciously or not, this guy used centralized exchanges as a mixer, and now he has a massive wallet from multiple different exchanges, holding a bunch of assets, and nobody has any idea who he is. However, you can still, if you get a little nitty-gritty, dig down a little bit deeper and find out who this guy is. So, for his Frac shares, he received $500,000 tokens from Copper, which is an institutionalized trading platform, and 318,000 tokens from Binance 14. Copper is the interesting one in particular. Copper is not heavily used. It tends to be only used by certain hedge funds. We can use that. In the second picture, I'm looking at the top transactions for the past 2 weeks where people are sending FXS, Frac shares, to Copper. And indeed, this wallet that I want to learn more about, they withdrew 500,000 tokens on February 28th. And here we can see that another address deposited 500,000 tokens to Copper on February 27th. Looking at that address, once again at the bottom, we look at their counterparties, and we do find a Dragonfly Capital address. We now have, within reasonable certainty, a pretty good idea that the holder of that $130 million wallet is Dragonfly Capital. That excites me. I love knowing that kind of stuff. I'm the only person, me and my 40 or so closest friends here, know one of the largest holdings of some pretty significant assets on chain. And that's because I was willing to do the legwork. This is not, one thing I'd note is that this is not an identification. This is one I did personally. That's not nonsense labeling. And I'm not sure if our attributions team would accept it. There's too much reasonable doubt there. We could look at the other exchange deposits and maybe put together a more compelling case, but it's really inference. There is an outside chance that on February 27th, somebody deposited 500,000 tokens, and on February 28th, somebody different withdrew 500,000 tokens. So they might not accept it. I know within a reasonable degree of certainty who it is, though. And that's good. That means that, I can look at what they're saying in the DAO forums, I can watch what they're saying on Twitter, and I can match that up with their on-chain activity. That is the definition of alpha. That is hugely important information for me and my holdings. And I think this is an example of how the institutional security and privacy posture is going to improve, but you just need to do a little bit of extra legwork to stay ahead of these folks. I think funds have much more important things to do, like making money, than to make sure that every on-chain analyst in the world isn't following their every move. So they'll take token steps, like using centralized exchanges as mixers to try and cover their tracks, but you can use more complex tools in turn to stay ahead of it. This ultimately means that alpha is going to become a little bit harder to find because they're not going to make it easy for you anymore to identify them. But if you're willing to do that work, arguably the alpha becomes even more potent, more tradable, more actionable. This still means that labels are important. It's going to be less you label, every label we see is Dragonfly Capital. But labels are still going to have a place. They're just going to become behavior-based and time-based. For instance, we recently expanded our coverage of the Arbitrum chain. It will not surprise you to learn, anybody here who's interested in Sybil attacks, that the majority of the new wallets on Arbitrum, they have a very short life. They're not connected to a known entity on Ethereum. Only very rarely, in the case of, again, certain NFT traders, can you tie those addresses to particular entities. But you can tag them based on behavior. For instance, participants in the Trident DAO public sale. This guy bought $100,000 worth of these tokens, and they quadrupled a few days later. Either this is somebody who knew something, or they're a degenerate that walks in the light of God herself. And either way, I want to know who they are and what that wallet's up to from now on. So even though we don't know who specifically this person is, we know that they are someone, or we know that they are very good, and we want to keep following them. So having these types of labels, behavior-based labels, remain important in a world where you have less named and institutional labels. So to sum up, though, I think retail and media are now thoroughly on-chain literate. This means that investor behavior at the institutional level and at the large-scale level, influencers who have significant funds, for instance, they're going to be covering their tracks significantly better. For those who are willing to do the work, though, to really go deep on platforms like Nonsen and use the more exotic tools, you're still going to be able to keep up with them, and you're still going to be able to find them, and that's going to make all the money you can make doing so all the better. And ultimately, I think a lot of sort of labeling and analytics companies that are focused on this notion of unmasking or uncovering what each address is tied to, they're going down the wrong route. We need more time and behavior-based labels, and potentially even using tools like AI to connect wallets that have similar behaviors, but no clear links between them. That's all I got, and I understand we're running a little over, so thank you very much.